You are watching Elliott Wave FX. Gold price extends losses into fourth consecutive week. Is the safe haven bid finally cracking? For centuries, gold has reigned as the ultimate financial safety net, a quiet, non-yielding anchor that investors rush to when the global economy begins to fracture. Yet, the current dynamics in the precious metals market are forcing a dramatic reassessment of this narrative. Spot gold prices have extended their losses into a fourth consecutive week, slipping below the critical $4,100 per ounce threshold. This prolonged slump has ignited a fierce debate across trading desks from London to New York. Is the legendary safe haven bid finally cracking? Or is this simply a textbook consolidation phase after a historic, multi-year bull run? To understand where bullion is heading, we must unpack the powerful macroeconomic shifts driving this 4-week downturn. The macro anatomy of the slump. Gold's recent slide is not happening in a vacuum. It is the direct result of a perfect storm of hawkish monetary policy, cooling geopolitical anxiety, and a surging US dollar. 1. The higher for longer Fed and the Warsh factor. The primary antagonist to gold's upside is the Federal Reserve. Under the leadership of Federal Reserve Chair Kevin Warsh, the central bank has taken an aggressively hawkish stance. Recent comments from Chair Warsh have reinforced expectations that U.S. interest rates will remain elevated for significantly longer than the market initially anticipated. 2. The mighty greenback. Compounding the pressure from interest rates is a fiercely resilient U.S. dollar index, USDX. Fueled by the Fed's hawkish tilt and solid domestic economic indicators, the dollar has held near one-year highs. Because gold is globally priced in greenbacks, a stronger dollar makes bullion significantly more expensive for foreign buyers holding alternative currencies. This currency friction effectively dampens international retail and institutional demand. 3. Easing energy and geopolitical risk premiums. While geopolitical risks in the Middle East remain fundamentally elevated, a subtle shift in the market's risk perception has stripped gold of its immediate panic premium. Ongoing U.S.-Iran negotiations and the resumption of smooth oil and liquefied natural gas, LNG, flows through the strategic Strait of Hormuz have drastically eased immediate energy supply fears. As crude oil prices retreated from their peaks, fears of a broader, oil-driven inflation shock receded. When systemic fear dissipates, the urgent institutional mandate to hoard gold as a safe haven weakens, leaving the asset exposed to pure macroeconomic fundamentals. Is the safe haven bid truly cracking? To determine if the safe haven status of gold is truly in jeopardy, we must separate short-term cyclical noise from long-term structural reality. The bear case, a temporary crack in sentiment. The argument that the safe haven bid is cracking rests on the fact that gold is failing to rally despite persistent global vulnerabilities. Total net central bank purchases have cooled somewhat from the staggering, record-breaking levels witnessed over the last 3 years. In the retail sector, double-digit demand losses have emerged in global jewelry fabrication, as consumers push back against elevated price baselines. Furthermore, speculative capital has temporarily drifted away from defensive metals toward high-performing risk assets, such as AI-driven megacap equities and yielding fixed-income products. When mainstream investors choose to ride equity momentum rather than hedge against economic collapse, gold's safe haven velocity slows dramatically. The bull case, deep structural support remains intact. Conversely, looking beneath the surface reveals that gold's strategic foundation remains incredibly robust. While reported central bank buying has hit a modest speed bump, evidenced by overt portfolio rebalancing and public sales from nations like Turkey, unreported and over-the-counter, OTC, institutional buying tells a very different story. Market insight, according to data tracked via Swiss refinery flows and the London OTC market, global institutional accumulation actually increased quarter-over-quarter. Chinese net imports of gold, for instance, inflected sharply higher, multiplying compared to previous periods. Furthermore, the fundamental drivers that triggered gold's multi-year ascent have not disappeared. Sovereign debt realities, global government spending remains unprecedentedly high, and long-term concerns regarding U.S. fiscal and budgetary sustainability continue to mount. The dollarization trends, fragmented global alliances and weaponized financial networks ensure that central banks outside the Western sphere face a permanent, strategic mandate to diversify their reserves away from the US dollar. Sticky inflationary pockets. Despite the Fed's aggressive posture, structural cost pressures, underpinned by high supply chain costs and global green energy transitions, suggest that policymakers may eventually choose to tolerate elevated inflation rather than sacrifice broader economic growth. Technical outlook. The key levels to watch. From a purely technical perspective, gold's 4-week slide has pushed it into a critical consolidation zone. The asset is currently carving out a macro floor, and its next major structural move will likely be defined by two pivotal boundaries. The support floor, $3,800 to $4,100. This represents the immediate area of defensive cushion. If the Fed executes back-to-back rate hikes and the dollar experiences an extended breakout, gold risks a temporary flush down toward the $3,800 baseline. Long-term institutional accumulators view this zone as a prime, buy-the-dip, accumulation territory. The resistance ceiling, $4,340 to $4,730 to invalidate the current monthly downtrend and prove that the safe haven bid has fully returned. Gold bulls must reclaim the 200-day moving average near $4,340 and break cleanly above the 50-day moving average at $4,730. A clean breakout above these technical levels would signaling that the macro consolidation phase is over, paving the way for a resumption of the primary bull market. Conclusion: a pause, not a collapse. The safe haven bid for gold is not cracking in a permanent or structural sense. Instead, the market is undergoing a necessary, healthy cooling-off period. After booking historic, near unprecedented gains, gold is temporarily bending to the harsh realities of a hawkish Federal Reserve and a punishingly strong US dollar. Gold does not require an active, immediate global crisis to sustain its intrinsic worth. It merely needs the macroeconomic backdrop to remain exactly as it is, defined by escalating sovereign debt, fragile geopolitical realities, and structural inflation. Until the structural fiscal imbalances of the global economy are fundamentally resolved, gold's status as the ultimate safe haven of last resort remains entirely secure. The current 4-week decline is not a sign of structural failure, it is simply a cyclical opportunity for the patient investor. Thanks for watching Elliott Wave Forex.